We're very lucky to have Justin Roberts with us from Starfish Ventures. Now, Justin has been with Starfish since 2013 as an investment professional, focusing particularly in the technology space. But the reason that we're excited to have the opportunity to pick Justin's brain is that he is responsible or covers all aspects for the investment life cycle, from deal sourcing, execution, right through to portfolio management and exit creation. But ladies and gentlemen, if we can give a Disruptive Startups welcome, please make welcome Justin Roberts. Thank you very much for making the time tonight to come along. One of the most important questions from the site were particularly about what other alternatives to shareholding that VCs have in their target companies. Like, is it simply like a loan, or do you require an equity stake in every opportunity?
Yeah, no, we get asked that a lot, and what I'd say firstly is, startups are risky. So for us to justify those risks, we have to take an equity stake. We're looking for big exits, and you can't do that with a debt product, unfortunately. So generally, we're taking equity stakes. There's different ways that equity can look. We look at convertible notes, we look at common shares, we look at preference shares, but debt's not something we generally will do. In the US, there are certain banks that will do venture debt, but they're generally for later stage companies, not for that real startup.
Okay, good. Thanks for that. What sort of capital structures do VCs typically want to see in their target companies to provide like a big incentive for the investment? Yeah,
so I guess if I think about that question, there's probably two parts to it. So what do we like to see before we invest, and what do we like our investment to look like? So generally, we like simple structures. We like a structure where the main entrepreneurs, the main team, have a good, healthy stake, that they're not going to get diluted too much down the path. We want our economic interest aligned to their economic interests. So that's kind of what we want. In terms of what we look for, as I said, startups are risky. We're looking we generally don't like to take control in investments that we make. As I said, we like to have the entrepreneurs controlling the company. We like to be an active minority investor. Often, depending on exactly what the entrepreneurs are looking for, we might give higher valuations than obviously what the companies are worth. Startups are very difficult to value, but for that we might take preference shares, and that kind of protects our interest while giving the entrepreneurs the maximum opportunity to maximise their value.
Okay, good. Thanks for that. So in terms of what you were mentioning there, is there a separation between control and equity, or do you provide opportunities to advise on control?
Yeah, so as I said, we don't like to control through our shareholding, and we don't like to control companies. I mean, ultimately, if a company's going to be successful, it's going to be successful because the entrepreneurs know what they're doing, they have drive, and they're good at what they're doing. We like to have some influence. We're active investors, so we generally like to take a board position, so we can see how the company's performing on a month-to-month basis. Have input on strategy, budgeting, etc. Really try and share our expertise. Obviously, shareholder interests that we kind of talk about reserved matters and protecting. Without getting too technical, trying to protect our interests, and you write that into things like shareholders agreements. Generally, our view is if you have to rely on shareholder agreements, that's not a good position to be in. We want a good partnership with our investee companies. As I said, it's a partnership. We want to work together. We don't want to have to be fighting on issues. And this is actually a point for for people trying to raise money. You want to find an investor, that works for you as well. Like, it's not just a one-way street. So you really, you should be courting lots of people, trying to find someone that really kind of fits with your investment philosophy, kind of what you're after, and
So on that point, you've got a board position. Do you influence things like the remuneration of key personnel or anything like that? I mean, how involved does that board position get?
Yeah, this is funny. I mean, we probably spend more time than anything on this particular topic. I mean, we want our entrepreneurs to be fairly compensated. In the end, you're always trying to find out what's the right balance between salary, bonuses, options, shares. As I said before, we're always trying to align our interests with our entrepreneurs' interests. When people ask that question, I think of one of our investee companies, and it's a great little business. When they went to raise money, a lot of people always try and put their budgets forward and take big salaries, and they see this as a way to make life a bit easier for themselves. These guys actually went the opposite way and kind of minimised their salaries. They're the lowest paid employees in the company, but for that they're able to have a smaller budget and therefore able to get a bigger valuation and require less money, so they ultimately own a greater percentage of the company going forward.
So it doesn't necessarily mean that just because you're bootstrapped, it doesn't mean that you're necessarily going to get a bad valuation. It could actually work in your favour. Yeah,
as I said previously, we want to give good valuations because we want our entrepreneurs in our investee companies to have a good stake in the company. We don't want them to get diluted down to a point where they go, look, what's the point? I own 3% of this company. I don't care. I'm going to walk away. Yeah. We're happy to give good valuations. There's ways you trade. You trade for that. As I said, we might take a preference position. So that kind of protects our interest to a degree. But ultimately, if the company becomes a $100 million, $200 million, $1 billion company, it's the entrepreneur that makes the biggest windfall out of it.
Yeah, good. What are your views as a VC on crowdfunding? We
think it's a massive part of funding in the future for startups. Really interesting, and if done right, as will play a massive role. There's two types of crowdfunding. So you've got your normal crowdfunding, which is say you're trying to sell a product or you're trying to fund an album or some creative solution. People will try and kind of pre-sell or sell something away. That's a much simpler source of crowdfunding. In saying that, it's also potentially a lot riskier. I don't know if anyone has seen The Coolest. It's they raised the most money on Kickstarter, raised $13 million. They're selling a really cool esky. It seems to be doing really well. But if they don't get it right and say they got their costings wrong or they did something incorrectly, they've now got also a $13 million debt. Equity is a lot more forgiving. So that kind of leads to the other part of crowdfunding, which is equity crowdfunding. Governments are trying to get the regulation right on that. It's not easy. I mean, you look at listing on a stock market. There's so many listing rules and things that you have to comply with. That doesn't exist for crowdfunding at the moment. And you got to get that right. Also, from a venture capital point of view, we think about crowdfunding, and if people are going to raise money on a platform like that, and say they sold $1,000 shares to 1,000 different shareholders, that's not good for anyone going forward. You don't want to have 1,000 investors. It's just too difficult to manage. So, entrepreneurs need to think, and startups need to think about these things. There's no silver bullet. And just really think that every kind of decision you make where you think, oh, look, this is fantastic, I'm going to raise $1 million, this is great, but that might have consequences later.
So would your preference be then to invest in an opportunity that has had a successful crowdfunding experience, or would you rather have someone that hasn't gone into that process yet?
Yeah, so say if the company had a successful product crowdfunding, that'd be really interesting for us because the market likes it, they've got traction, people think it's a good product. The equity crowdfunding at this point is we just don't understand it enough to really even think about it. But in saying that, there is a couple of good platforms out there. I don't know if anyone's heard of AngelList. That's a really interesting platform where you can you put your idea forward and hopefully you have a syndicate kind of lead the investment, and that's more kind of traditional. So you have one real investor who takes a board position, protects the interest of the shareholders, and hopefully invest through some structure where it's really one shareholder into the company rather than 1,000 different shareholders.
So we hear a lot about having a plan and having a pitch and all these sorts of things, elevator pitches. Should a startup formulate a structured business plan, then seek VC funding, or do you want to get involved in the formulation of that plan?
Yeah, so I think this depends on two things. One depends on the company and also the venture capitalist. So if it's a company that is very capital intensive, obviously you need to have a strong business plan. It's very difficult to find the money for a business that requires, say, $10 million to build a prototype. So you might go to a venture capital earlier than you would if you had a very capital light business. From that point of view, we'd look at a good business plan. We'd be very happy in that situation. If it's a capital light company, we'd expect them to have launched something first, whether that's something self-funded, whether they've gone down the angel path first, or crowdfunding. We'd expect to see we'd like to see some sort of traction first, whether that's revenues, whether that's eyeballs, whether that's likes on Facebook, who knows what it is, but we want to see that
some sort of interest,
some metric that people are interested in this product, and and people are going to buy it.
Funding for operational expenses versus capital growth. What's your take on that? Not just to pay salaries, of course, but operational expenses versus some sort of growth plan. Yeah, I mean,
we're always looking for growth companies, so we'd much. Not rather, but we're obviously a lot more interested in backing a company that looks like it's on a path to profitability and is really just trying to speed up growth, and we're that facilitator for growth.
Okay, good. We talk about a pitch, and we've heard around sort of growth and all those sorts of things. I think one of the biggest fears for a startup is getting an audience with a VC and then determining that the pitch doesn't have the right goods, it doesn't have the right information in it. What's a good solid pitch look like or sound like?
Yeah, so there's probably, again, two parts to that. So the first part is actually trying to get a meeting, and that's might be the hardest part.
Yeah, we'll ask you how to do that in a minute, by the
exactly.
way.
I mean, look, people will call our office, send an email, and I mean, if you can't in 30 seconds or two, 3 sentences explain what you do succinctly and articulately, it's almost too hard. We'd say we see. I know we have 1,000 people, maybe 500, 1,000 people, try and contact us every year. We try and meet with, maybe a few hundred. So that's the first thing. You just got to be succinct and tell us what you're doing and why you're going to be a great company. Then obviously, get the meeting. What do we want to see in a pitch? There's probably 4 things I'd say we want to see. A good team, and there's this. It's kind of saying in venture capital that even a good team can make a bad idea, make it into a reasonable company, but a bad team could make a good idea into no money. So, the second thing is we want to see that there's what the value proposition is. Why is the company going to be successful? Why are customers going to buy this product, or why are they going to engage with this product? The third thing is market. What's the size of the market? Who are the competitors? Is it a crowded space? And the last thing is, what does the exit look like? We typically want to invest somewhere from 3 to 5 years, so we want to know that there's a clear path to exit.
Okay. So obviously good team, but at what stage should a startup look to getting VC funding? Like at what point during the business cycle, I suppose?
Typically, a VC wouldn't want to make more than say 10 to 20 investments per fund. It's too hard to manage more than that number of investments. So if you're a fund that's raised, $10 million, you're looking to put $1 million to work. Our funds typically look 150 million. We're then trying to invest in 10 to 15 companies. We would be looking to an ideal investment would be somewhere from $3 to $5 million as the initial investment, and hoping to put another $3 to $5 million to work over time.
When you say get a meeting, what do you need to see in an email or hear on the end of the phone for you to pique an interest in an opportunity?
Yeah, so as I was saying before, it's kind of that 2 sentences about why you're either engaged with customers or you're going to be able to engage with customers, and kind of what separates your business from any other business. I mean, we get so many people coming in, I've got this fantastic idea, we're doing something no one else has ever done before, and the first thing you do is get onto Google and have a look, and there's, sure enough, 10, 20 companies out there doing similar things. Now, not to say that this business isn't a better business or isn't going to be successful, but you have to be able to clearly articulate why your business is going to be successful.
They were the top 10 questions that came off the meetup site. Are there any questions out there that you'd like to ask Justin? And it's not, do you have any money? Philippe.
If I could ask, the Australian VC industry is ridiculously segmented and very picky in terms of mandates. For Starfish, is there a particular mandate, is there a particular industry vertical or something, where's your sweet spot for investing? And given the segmentation of the market for most startups here, do you recommend from the very beginning looking for funding overseas rather than just focusing on Australia?
Yep. So in terms of Starfish and where we invest, so we're technology and kind of bioscience investment fund. We probably put 70% of our money to work in technology and 30% in biomedical. In terms of should companies go straight overseas, look, that depends on the company and what they're after. Australia is actually generally pretty good in the early stages. There's a great range of angel investment, so it's really good for companies trying to arrange that original seed funding. The next stage is there's a few VCs. I wouldn't say there's huge support for venture in Australia, even from institutional investors to a great degree. Which makes it hard because there's limited resources available. But generally, that Series A round is covered, and good businesses will get money. It's probably that next stage that you're talking about where it's a bit harder, and that kind of $20 million round. I can't think of a VC in Australia that actually funds that stage.
Okay, thanks for that. So a proven technology versus traction in the market. Would a VC look at the opportunity for technology? Yeah, it sounds like you might be asking that for a reason there, sir. So we'll.
Absolutely. I mean, if there's a great technology out there, and you can prove that it does something different and better than anyone else, yeah, absolutely. I mean, we want to invest in great technologies. It's a much bigger piece of due diligence work then afterwards. Looking at the IP. What do you have? Why is it defendable? And that's obviously a much harder question. Ultimately, we like businesses that are simple. A good business is a good business. But as I said, if it's a great technology that has a great business behind it, yeah, absolutely. I think VCs are going to be very interested in it.
Does something need to be, sort of trademarked or have an IP protection process in terms of does that make it more or less attractive, or does it matter at all?
I think it can't hurt, but I wouldn't say you'd need to have it. And even if you have it, it might not necessarily be worth that patent or a bigger thing is customers engaging or you're getting traction, because you go, well, then that's a business that people like, that people engage with. Technology on its own, you might have the greatest technology, but if people don't want to buy that technology or engage with that technology, then it doesn't really matter.
Yes, right at the front there.
Just for a new product, have you been invested on a new product before crowdfunding, or would you be interested to invest on a new product worldwide that nobody done before crowdfunding? Would it be a scenario that you could envisage?
Again, if someone presented something to us that just blew us away, and we go, oh yeah, look, we can see that's going to be an absolute, a killer product. I want to buy that. The partners want to buy that. Everyone wants. We know people that want to buy that. Absolutely. I mean, if it's a great product, it's a great product. And again, there's different VCs that will invest at different stages.
We know what you're looking for in an idea or traction in a business, but what are you looking for in a person? And I think we've had this conversation, so I'd be interested to have you articulate that.
Yeah, so I'd say the biggest thing is passion. Ultimately, you want people who are passionate about their product. They believe in their product. They think that this is the greatest thing, and they're going to go to the ends of the world for the product. As I stressed numerous times, it's all about alignment. And so if people are in there thinking, I want to flip this in a year and walk away with a number. Like that's not a good place to start from. You want people that just really believe in the product, and success and money and all that. That's a byproduct of it.
If a business is worth or a company is worth $100 million, and the venture capital invests $10 million, does that automatically equate to a 10% shareholding?
Yeah. So what I'd say is a $100 million business is probably an easier business to value. So when you talk about a $100 million business, it has reasonable profit, and so then we have a bit more certainty about the valuation. So it might just be 10% in say ordinary shares or whatever it is. It's earlier stage, it's a lot more difficult where you're kind of guessing at numbers. What's the valuation of a business that that's you're burning $1 million a year, that that has $100,000 revenue. This is what I was saying before. Look, we might actually give bigger valuations than what the company's actually worth. But for that, we might take a position where we might take a convertible note or a preference share where we protect our interest in the first stake, but it gives the entrepreneur much more upside than they would if we were going to say, well, okay, look, that's $100,000 in revenue. I've got a corporate finance background, and when I kind of came into venture capital and I kind of heard the valuations these guys are talking about, I was like, oh, this is just crazy. Like, how could that be worth that? But they're like, no, you're not. You're trying to ultimately align the entrepreneurs with ourselves, and by doing that, we are going to get the best outcome for everyone. So, as I said, $100,000 revenue, I'd say that's worth $200,000. But if we gave you that valuation, you wouldn't have any shares.
Okay, so the question there was, what sort of exit strategies do you look for?
Yeah, I mean, there's obviously there's numerous ways you can exit investment. Certain types of companies generally have not a set path, but a regular path to exit. Trade sale, IPO are they're probably the only real ways you can exit. So, but in saying that, so sometimes we might look at companies that I think we're talking more about freemium products and products that actually don't may never create revenue for us, but they have a great technology. But that doesn't mean that there's no exit strategy. It just means you're going to go for a trade buyer or someone who's going to buy that technology and integrate it into their bigger company and use that technology. If it's something that is a product that you can actually generate revenue, then obviously there's a lot more options. You can sell to a trade buyer. You can IPO.
Okay, good. Any further questions? Peter.
I understand every deal is different, but typically what percentage of the company do you ask for at an early stage?
Yeah. So as how long's a piece of string? Like, it depends on kind of how much money the company needs, how much the company's worth. A good investment for us is say 25 to 35%. That's ideal, because we're investing in early stage, but not the earliest stage. So there's generally always going to be more and more funding rounds, and what we don't want to do is be in a position where we get diluted out ourselves. So 30% is generally a pretty good number where we're in there, we're back in the companies. We'll often follow on as well. So when it comes to the next round, as I said, we want to kind of back companies and be there for them.
Good. Thanks for that. One more from over here. Yep. So I think the question was, once you do invest in a business, where do you want to see the money go, effectively? Operational, marketing, growth,
So there's probably two areas, operational and marketing. Operational, obviously you need to grow teams, and before, there's no point just spending a ton of money on marketing if you don't have the infrastructure behind you to kind of to scale the business. So we want to see our businesses well equipped. We don't want to see CEOs answering phones and taking inbound calls and doing customer support and those kind of things. So we want to see businesses scaled up to a point where they can really be in the best possible position to grow the business. But ultimately, we want to see money going to growth.
Sir, at the front here, with the watch.
Is there a place where I can find the list of all the venture capital companies in Australia?
Is there a list where you can find all the venture capital? Actually, that'd be interesting. Is there a list?
No, not that I know of, no.
Yep. We have one, but it's worth a bit of money, No, I'm kidding.
to get that first meeting, we were saying it's hard. Using platforms like LinkedIn or so to find people you may know that know me or know the guys at Starfish, that's going to be the easiest way for you to get an introduction. If you can find someone that knows someone, a warm introduction is always a lot easier. And I can't think of a scenario where someone said to us, "Look, can you meet my friend? We think he's got a great business. Will you meet up with him?"
Yeah. Okay. One more behind that. Yeah. Yep. So just to repeat that, you look for whether VC's looking for synergies within companies within that portfolio.
I wouldn't say that's something we look for. Obviously, it's something interesting if the opportunity came up. But more so, I think once you understand an industry and then you see a similar company and you think, they're doing something really cool, it's obviously a lot easier for us to then make a judgment of if it's a worthwhile business and if there's got if that business has good potential. But we wouldn't invest because there's synergistic values.
Okay, brilliant. I think we might conclude the Q&A there for a session. But ladies and gentlemen, could you join me in thanking Justin very much for his time?